the recording. All right. And then let me allow people to come in. No note takers here. We got regular people. All right. All right. All right. All right. Good morning. Good morning. Good morning, everybody. Thank you for joining us this morning. And we're going to get started in just a few minutes. So get your questions ready. We are talking about all the different types of accounts you can use to grow that money for you and for your employees. That's what we're talking about today. So please get all your questions ready because we will have Q&A. I'm excited, y'all. I got an amazing VIP guest with us this morning. Woo! Yeah, we about to, all right, it's gonna be nice. All right, so we're gonna get started in just a few minutes, y'all. Good morning, good morning. Thank you for joining us. I love this. People on time. That's what I'm talking about.
They are ready.
People on time. They know it's about to be some gems dropped.
Yes.
And picked up. All right, so I'm letting people in. Make sure I let the right people in because I don't know who Read AI meeting notes is. So we will not be allowing you in the meeting, Read AI meeting notes. Yeah. We are recording this for the chamber, y'all. So let's be on our best behavior. It's going on YouTube. It's going on YouTube. And if you are not familiar, yes, the Atlanta Black Chambers has a YouTube page. So we're going to need y'all to just join us and subscribe. Our goal is getting to 1,000 subscribers. Not sure where we're at right now, but we're close. We're close. We need y'all help. We need your help, y'all. So while we wait these next 4 minutes, go ahead and go to YouTube and subscribe to the Atlanta Black Chambers YouTube page. Go ahead and do me that favor, y'all. Go ahead and do that. As we wait, we're about to get started in just a few minutes. I know a bunch more people are coming, so I will wait on. I'm not singing. Don't even. Nope. Not singing today for y'all. All right, we are going to get started in just a few minutes. Good morning. ABC Member of the Year, Joseph Harlan II. Thank you for joining us, sir. I always appreciate you. And my man, Kevin, good to see you. Kimberly, good morning. Good morning. Shout everybody. Good morning, Lonnie. Good morning, Leeway. Mary White, Robin Williams, Tamisha, I think.
Tamisha,
maybe?
Maybe.
Don't. She pronounces it Tamika, though.
Tamika. Oh, my bad.
That's Tamika, Georgia.
Tamika. Okay.
Tamika. My fault. Won't do that again.
Tamika's getting ready to let us know.
She's like, y'all both wrong. Melvin got it, though. Good morning, Stacy. Good morning, Will. Good morning, Vanessa. Good morning, Tasha. Oh, one of my favorite people just joined us. What's up, Nandy? Good morning.
Well, we got some Cleveland, Ohio folks.
How are you?
I am wonderful. Good to see you. Thanks for joining us. Let's see who else we got over here. All right, Mr. Javon Franklin. Good morning.
I love it to see it.
Yes. I see a lot of new names. I'm still new technically to the chamber. It's only been like 3 years, so I'm still new. Chamber being here 20, and so it's good to see some new names. Though I'm glad y'all could join us this morning. All right, so All right, let's kick it off. Let's kick it off. So, good morning, everybody. Thank you for joining us today. I am your esteemed and honored financial services, aka the Money Team Chair, Chike Uzoka. What I do is I partner with HR teams to help increase employee retention, productivity, and company profits overall. So we help our employees build a strong financial house on strong foundations so that they stay at their jobs longer, they're more engaged, they're more productive, and companies get to thrive and help more people. And so that's what I do. I have been the chair of the money team for almost exactly, actually a little bit over a year. I believe it was like August 4th of last year. And I love what we're doing. We have some amazing folks. We have some money team members on the call today. And so thank you for joining us. Thank you for joining us. Today, this month, we are talking about how to grow your money. So if you are ready to learn how to grow your money, I just need you to put just put some money. Just put money in the chat. The word money. I want to see the word money. Let me see how active we are today. All right, let me see how active we are today. If you're ready to learn how to grow your money and your employees' money, because I know y'all got employees, right? All right, we got some active people in the chat. Okay, Joseph, I love Joseph. he said, cash flow, baby. I love it. I love it. I love it. I love it. And so this is our monthly webinar. We do this webinar every second Wednesday of the month, except for December. Y'all know the chamber has to take a break in December. So other than December, we do our second Wednesday webinar at 11 a.m. And we're excited. We're excited. We took a couple months off to regroup and just give ourselves a break. Sometimes you just need a break, you know, like I know y'all know. Business owners, we know. Sometimes you need a break. You don't want to answer the phone. Do not disturb. All right. Mm-hmm. And so I'm excited to talk about what we are talking about today. So what are we talking about? We're talking about all the different ways you can grow your money, all the different types of accounts and whatnot. And so because it's September, can anyone in the chat tell me what is the significance of September? What month is September? I know every month has something, right? Like, you know, financial literacy month is April, and October is financial planning month, right? So can anybody tell me in the chat what they think or know? What month is September? Something awareness month.
It's Life
That's
Insurance Awareness Month.
In the chat, Nandy, in the chat.
Oh, sorry.
Yes.
Sorry.
Yes, it is life insurance.
My computer, my Wi-Fi is acting up, so your voice is tapping up. I apologize.
I got you. So it is Life Insurance Awareness Month in September. Thank you, Kimberly. Yes. And so the first thing that we're going to talk about is life insurance. Now, if you have it, put a 1 in the chat. If you would like to talk to somebody about it, you could put a 2 in the chat. We're not judging here. We're just keeping it real, right? If you have it, and maybe you haven't looked at it in a while or reviewed it in a while, put a 3 in the chat for me. All right? And so we are talking about life insurance because it's Life Insurance Awareness Month, y'all. This is important. This is super important. We're talking about generational wealth from just one person. When they're gone, a check shows up that could be used for generations and generations, y'all. And so what I want to do is first, let's break down life insurance because there's a lot of talk and a lot of phrases people like to use about life insurance, right? Yes, Kim. Yes, Kimberly. It's a tax-free check. Creditors can't touch it. Nobody you owe money to can touch it, right? And so we're going to talk about that a little bit. So the 2 types of life insurance are permanent and temporary. Those are the two types of life insurance, right? You have permanent and you have temporary. Now, let me share with you underneath each of these, right? There are different types of each. So for the temporary insurance, we have term insurance. I'm sure y'all might have heard the word term insurance before. Term insurance comes in a range between 1 year, sometimes called annually renewable term, and I think I've seen it up to 40, 45-year term, right? And 5-year increments along the way. And so what term insurance does is it allows you to rent your insurance, right? You get to rent it for that amount of time, and you can re-up at the end of the term, but just remember, you're a little bit older at the end of that term. So if it's a 5-year term, you're now 5 years older. So that's not going to be the same rate. All right. And so if you are okay with paying a higher rate when you re-up, that's for you, right? Also, term insurance is a little bit less of an investment than the permanent type of insurance, right? And so, and Charles, we're going to get to your question. If you have no one to leave money to, do you still need life insurance? We're going to get to that, and I hope we answer your question in what I share. Okay. So, also under temporary, and this is a Chike Uzoka thing, not a Atlanta Black Chambers thing, not the firm I work with thing. This is Chike's view that also under temporary is UL, IUL, VUL. What do I mean by that? Universal life, index universal life, and variable universal life. And people are like, wait, what? I thought that was permanent. Here's what happens. If you have a universal life policy, if it's not set up correctly, you could be paying the premium every single month and the policy might still lapse. It's like you paying your rent every month, but the landlord didn't pay the mortgage. And if you're in a state like Jersey's different. Jersey, they'll let you go. They'll let you rock. In Georgia, oh no, you out. You out. And so you have to look at universal insurance like that. And so how universal works is it's like a temporary policy that kind of renews every year, so the cost goes up, right? And if you're not paying enough and the cost rises, there's a gap, and that gap will be filled, unfortunately, by the cash value that's in the policy. Index universal life just means that the money in the policy is tracking some sort of index, aka S&P 500, right? Variable, anytime you hear the word variable, y'all think mutual funds. Variable universal life means that the cash inside of it is based on some sort of mutual fund you have selected. So however the mutual fund performs, that's how your cash value is going to perform, right? And so under temporary insurance, we have term, IUL, VUL, and UL. Under permanent insurance, we have whole life. And as it states, you can keep it for your whole life, technically up to age 100, because after that, they're like, you just old. Here's your money back. You're about to croak any day now, right? And so with whole life, it is more of an investment. However, the burden of the investment is not on you, it's on the insurance company. So your premium stays the same every single year whenever you get it. It's always best to get it when you're age 1. And be honestly, if you can get whole life insurance at age 1 or 2 or 3, 4, 5, get it then, because the earlier you get it, the less of an expense it is, right? Because you're further away from age 100. That's how the insurance company looks at it. The closer you are to age 100, it's more of a risk for the insurance company, even though the investment, the cash value growth is on the company. They're going to make you pay more because you're older. It is what it is, right? And so with permanent insurance, your premium, part of it goes to insuring you and part of it goes to the cash value account. All right. That cash value can be used for anything you want, anything. And unlike some of the accounts that my esteemed guest is going to talk about, there is no waiting period technically, but you have to have money in there to use it, right? I know there's this social media influencers are telling you that you can start a life insurance policy today and start using it as your bank tomorrow. No, y'all, no. The cash value has to grow inside of the policy for you to be able to actually use it or loan from it, right? And so you don't have to wait to necessarily a certain age, like 59 and a half. You don't have to tell them what you need the money for, like a 401k. It's your money. Hey, life insurance company, give me some money. Okay, that's it. All right. Now, there are pros and cons to life insurance. Let me be real with y'all. There's pros and cons to everything. So with the term insurance, if you don't pass away in that term, that money you put into it is gone and there's no policy payout because you didn't die, right? It's just like car insurance. You can pay your car insurance every single year and never get in an accident. You don't go to the car insurance company like, hey, I didn't get in an accident this year, give my money back. No, you were protected while you were driving that car. So if something happens to you in that car, you're paid. That's how the term life insurance works, right? The good side of term insurance is you get a lot more insurance for your premium dollars, right? You know, maybe $50 a month for $500,000, depending on your age. Okay. And with the permanent insurance, you know, yes, it's more of an investment, right? But you're also getting the benefit, the living benefit of being able to use those funds while you are alive, right? And you can use those funds while you're alive. And when you pass away, guess what? There's a tax-free check still going to your beneficiary. One thing about beneficiaries on life insurance, y'all, please do not put anybody under the age of 18 as your beneficiary on your life insurance. They cannot sign the paperwork when the insurance person comes with the check, and then you don't want to know what happens to that check. It's probably never going to your family because the state has to hold it. We know how they do with money, right? And keep it real with y'all. We can be honest, right? And so that's the side of life insurance we don't always talk about. And anytime I see a beneficiary as a child on a life insurance policy, I get a little like sketchy. I'm like, wait a minute. And so what I want to talk about with the cash value is the difference between the difference between the compound interest, right? And so okay, no problem. Compound interest is what happens inside your cash value. And if you know anything about compounding interest, it means interest on top of the interest, on top of the interest, on top of the interest, versus simple interest, which is just interest on your initial premium that you put in. And so if you can imagine like half a skateboard ramp, right? It starts out, you know, a couple years, it's not exciting, Chike, what's going on? And then eventually it goes up. So that's what compound interest looks like. And that's how the permanent whole life policies work, okay? And so we have temporary and we have permanent life insurance. Now, as an individual, you can get either or. right? When you're talking about your employees, and let's say you have a key person in your business, and if something were to happen to them, your business would suffer. There is something called key person insurance, which is basically business owned life insurance on the life of a key person, a manager, a CFO, a CIO, a CEO, right? And those are set up a little bit differently than the individual policies, okay? And what I love about it is you can get policies on you, your family, your kids, your grandmother, your wife, your spouse, and you can get life insurance for your employees. And think about when we talk about employee retention, when you let the employees know that they have that type of benefit coming into the job, that's a reason for them to stay even more, right? And so that's one of the things that I help HR teams is like, how do we make these benefits look good and work well for your employees so that they stay, right? Because in today's economy, employee disengagement is costing more than employee turnover. But that's another conversation for another day. We're here to talk about growing your money. All right. And so what I want to do is I want to get to the rest of the financial house, and I want to bring on a very, very, very important person in my life, right? Because what she does is she helps my clients when they have questions about investments. Yes, I'm licensed, but I know that this sister has been doing this for 3 decades, y'all. She is killing it in the game. And so I would like for Victoria Lowery to come on and introduce herself to the Atlanta Black Chambers and let them know where you're from, what you do.
Who you be, and
Who
all
you
that.
be.
First of all, good morning, good afternoon. I just am so blessed to be here. And I feel like since we're all Black folk family, I can talk about the most important factor in my life, and that's the man upstairs. So I have to give all praises and credit to God for giving me the platform and the opportunity by way of Chike to speak with all of you. I'm going to share my testimony today, my financial journey with all of you, because I think knowing a little bit about me is important so you can understand the why, the purpose in why I do what I do. But first, I'm going to tell you a little bit. My name is Victoria. I've been married to a business owner for it'll be 30 years in July. I have 3 grown children. I call them grids, my grown kids. So I know a little bit about life. And one thing I know is as a business owner, you have your highs and you have your lows. And I have been indirectly a witness to that by way of my husband starting from the ground up. So I feel I have a lot of stake in the game. And my purpose here today is to share it with you. So for one, a little bit about me, and I don't know if Chike is going to share my bio. I've been in the industry not 3 decades, Chike, more like 2. But that I've garnered a lot of experience in the financial world, all scopes of it. In addition to that, I work for Mass Mutual. I've been with them since the beginning, but a little bit about my history and how I ended up here, which I believe is relevant to this conversation. I started out as a child actress and singer and made some money in the early 80s, traveled with the legendary Whitney Houston as a singer. But then when things went disarray in her life, things went disarray in mine. I didn't know, to go back to college for what? To major in singing. So I decided to major in communication so that I could be an effective speaker. And in that, I actually went to a career fair, landed a job at Mass Mutual. And I asked the general manager at the time, my dad was a worker. He had 3 children. Mom was a stay-at-home mom. Why did he never know about life insurance? How come when he died when I was 16, my whole life got turned upside down? Why didn't anyone come and explain to my family about the importance of financial planning? And so he looked at me and he said, I don't know, maybe that's something you can answer as an African-American woman. I said, I will. So from that moment, I knew my purpose. My purpose was to educate and equip Black people in particular with the right resources so they can make good financial decisions. And y'all, my motto was simple. You do what you can, where you are, with what you have. So I would literally talk to anyone who got up every morning and worked, whether they were business owners, whether they were working for corporate, from a barista at Starbucks to the CEO financial director. It didn't matter. I was there to educate, and my purpose was full. And with God by my side, I'm still here. And so having the opportunity to speak with you all today was nonetheless of a blessing because there's a lot to share. So with that, I want you all to understand, I consider myself a retirement income specialist. And that's because I help my people create a lifestyle in retirement that they truly envision for themselves. And I know that everybody's retirement looks completely different. Some of these millennials and Gen Zs, they want to retire now, where I have my baby boomers who put in 30 years and they just want to make sure the pension they were promised will pay, in addition to Social Security that they assumed to be there. With those facts in mind, that's not always going to paint the picture that you envision. So for today, I want each of us to close our eyes. And really, I want y'all to see your retirement. I want you to see yourself, whatever age you are, however many years it is to come. I want you to really see how you want to live. If you want to live raising your grandchildren, traveling around the world, opening up a nonprofit, a charity, or continuing your business, see it. Because one thing I know, in order for you to implement what it is you see, you have to visualize it for yourself. And then where I come into play, I'm going to help you create the painting on canvases such as IRAs so that you can literally see the retirement that you have envisioned for yourself. And we can do it. I'm telling you, it can be done. You just have to understand the how. And that's where I play the role. So if this was the Wizard of Oz, I'm just going to show you how to follow the yellow brick road and get you to Oz, wherever that Oz may be to you. Does that sound good? Can't see the head shaking, but Chike, I'm going to go with yours. So once we've created the retirement we want to see, we got to put it to action. We have to take our painting and paint on that landscape so we can see it, y'all. Because if we can see it, we can achieve it. And I'm a firm believer in that. There's nothing we cannot do if we have a plan and we take our behaviors and our attitude and we put our plan into action. So for today, I'm going to get straight to the point and I'm going to give you all some takeaways, things, the 3 types of retirement plans that are really for business owners, because we're going to stay focused today. Now I run the gamut all across from young people. I just had a conversation with one of my child's friends. He just graduated from Howard University, HU, you know, and he wanted to know, Miss Victoria, what do I do? So I love talking to young people because the younger you are, the easier it is to achieve your goals. But for those of us who are in our 30s, 40s, and 50s, we're still going to get busy. Okay, so let's delve into it. So as I mentioned before, you are the boss. And in being the boss, heavy is the head that wears the crown. It is all on you. You are responsible for your retirement. Most business owners don't pay into Social Security, and I'm not sure it's going to be around long anyways. So you have to be accountable for the life and the retirement you'd like to see in the future. So in that accountability, there comes a lot of responsibility. Okay, you have to make decisions. So some of the choices that you have are the 3 that we're going to talk about today. The first thing is you need to understand your business. By way of understanding, I need to know how many people are in your business. Is it just you? Are you a solo entrepreneur? That'll direct you in this path, the solo K. Is it you, your spouse, or your partner? That may direct you in the SEP IRA. Is it you and maybe 100 or less employees? Now we're talking about a simple IRA. So as I just stated, there are 3. We have the solo K for the solo rock and roll entrepreneur. We've got the SEP IRA for you and a spouse, or I'd say 3 or fewer employees. And then if you have greater than 25, somewhere in the range of greater than 3, but less than 100, simple IRA is going to be the move for you. And we'll talk about why. And just for this meeting, a lot of the details I'm going to hold back and omit, and you can call me offline or set an appointment and we can delve into that as it pertains to your business in particular, because tax filing status, whether you're S-Corp, you know, whether you file a Schedule C, that plays a role too in terms of the tax deductions in all of these plans. But I'm just going to give you like a roundabout picture. So again, you can get your vision of retirement, get the right plan, marry it, and let's get down. Okay. So first thing we're going to talk about is the SEP IRA. I do a lot of SEP IRAs, mainly because a lot of people have a spouse who work with them and maybe 1 or 2 employees. So the biggest thing is 100%. Let me back up real quick. For those who don't know what I mean by SEP, the acronyms are S as in Sam, E as in Edward, P as in Paul, which stands for Simplified Employee Pension. Back in the day, for all my baby boomers on the call, yourselves or your parents probably had a job, and they were granted and guaranteed a pension, meaning lifetime income for years of service. They paid their time in the business with the company, and in return, they're going to promise them an income for life that they can never outlive. But guess what, y'all? Companies are no longer doing pensions anymore. They're literally getting out the pension game. Even if you work for a corporate office, rarely do you find companies that offer pensions. So they're pretty much allowing you, be it 401k, to do it yourself. They want you to be responsible for your retirement, which is fine as long as you're making moves along the way. So SEP IRA, Simplified Employee Pension, they have rules because these are all considered qualified plans. When I say qualified, simply means the IRS is qualified to get in your business. That means any type of qualified plan that you have, or if you see the word qualified, that means, oh, I got to deal with taxes on this at some point or another, either going in or coming out. The benefit of a qualified plan, which all of these I'm going to talk about, are your money that grows is tax deferred. You will not pay taxes on the money as it grows. However, you will usually always pay taxes when it comes out. Okay. But it's a benefit to business owners because it's tax deductible. So for the sake of the SEP IRA, you have a maximum contribution limit. So the maximum is 70,000, meaning you can never put any more than 70,000 in this plan in any given year. It just went up from 2024. So how that 70,000 is broken down, you as the employer can pay up to 25% of your employees, which is usually 3 or less, compensation. Plus, you get to make up that difference. If you're the employer, you get to make up that difference where it meets 70,000. So they're going to cap it. And every dime of that, whether it's 70,000 for yourself and your spouse and your employee, you get to deduct all of it from your taxes. But there's a max contribution limit. And then inside the SEP IRA, only the employer can make contributions. So employees, if you have a good employee, y'all, one employee, and you know your business leans on this employees for its success, I call it golden handcuffs. They love when employers have SEP IRAs because they don't have to contribute a dime. You know, it's a benefit. So if you have one employee and your business is booming, think about investing in the SEP IRA. But just know this, whatever percentage you decide to contribute to your SEP IRA, it has to be equal across the board. You can't contribute 30% of your income for you and your spouse and then 2% of your employee. It has to be equal. So sometimes SEP IRAs are a bit costly to the employer because it has to be equal amongst all people, all participants. So think about that. So oftentimes when people say they want a SEP IRA, we look at the number of employees, how much money they have to contribute to this, what type of tax deductions are they seeking, and what does that budget look like in terms of, are you really willing to put this same amount towards yourself and wife or spouse or partner and your employee? So we have to consider all of these factors before we make a decision. Your employee is allowed to choose their own investment inside, but typically I will make recommendations, you know, based on their year to retirement. We'll put them in a target fund and go from there. Now, we've talked about the contribution limit, 70,000. We've talked about rules going in, which are it's tax deductible. Only the employer can make contributions. But let's talk about some of the penalties getting the money out. Because sometimes folks say, oh, my business, COVID hit, y'all. Lots of folks That's when I learned so much about the SEP IRA coming out, because COVID took down a lot of businesses, my husband's business included. Thankfully, it picked back up. So the rules coming out, 59 and a half. That is really the golden age, 59 and a half. That's when the IRS will leave you alone. They're still going to tax it as income going in, but they that you won't get hit with that 10% IRS penalty because you're not of age. However, there are rules, there are exceptions, and I'm going to give y'all the 4 exceptions. If you decide you need to take the money out and there's no other option, you don't have any other cash vehicle to pull from, the first option is first-time home purchase. So, and these exceptions or exemptions are across the board in all 3 of the plans I'm going to talk about. First-time home purchase, first time, y'all, not investment property. You must be living in the home. First-time home purchase, you can pull the money out with no 10% penalty. Will you be taxed? Absolutely. On that withdrawal, not necessarily, just when it's time to file, but there will be a tax consequence to it, but the penalty will be omitted. Second, educational expense. If you can prove you paid any type of college educational expense in the year you withdrew, you will be exempt from that 10% penalty. 3, disability. If you're proven to have a disability by the state, waived. Death, obviously, worst case scenario. And then the last one is we've got disability, first-time home purchase. We've got catastrophic illness. I don't know if it's medical expense. So if you have a major surgery coming up and you can prove you needed the money to cover like a bypass surgery, it's exempt. So other than those 5 I talked about, typically a 10% penalty will incur if you pull the money out of any of these IRAs that we speak about prior to age 59 and a half. Okay. And then we're going to have time for questions and answers. So I'm kind of going to go a little quick to make sure I get all your questions. All right. So we've got that down. Let's move on to simple IRA. So a simple, the reason why I like simple IRAs, but a lot of times if you have 100 employees or less, we're dealing with S corps. It just gets really complicated. Sometimes you just set up a whole 401k plan with me just to keep it in code with the IRS. There's a lot of rules and the contribution limits are very small. I think it's 16,500 is the limit. Let me make sure I'm giving you accurate numbers because I'm going off memory here. Simple IRA, I think the max limit is 16,500. If you're over 50, it's 20,000, which for business owners, they really want to have the opportunity to put more money in. And sometimes simple IRAs don't really allow that, but the same rules going in, 50 not taxed. All your contributions are tax deductible to the business. The difference in a simple is your employees can contribute. So as a business owner in a simple, if you have 100 or less employees, you contribute to them. You have 2 options, 2% of their compensation. It has to be equal amongst all your employees, which obviously that can get costly. Or you can do dollar for dollar up to 3% of their compensation, meaning the employees also can contribute. So the set, only you contribute for everyone, 3 or less employees. Simple, you contribute 2% or dollar for dollar up to 3, but the employers have the opportunity to contribute as well. However, combined, 16,500 if you're under 50, 17,000 if you're over 50, and 20,000 if you're 60 to 63. For all of you people 60 years old and 63, the Security Act of 2.0 just came up with a new rule. They added more. So you get what's called catch-up contributions. So they allow a little more of catch-up. And I think it's like an additional $11,250 a year you get to contribute to your IRA so you can catch up. They're saying, come on now, get on the good foot. Okay, so that's how simple works. And then the last one and the most convenient, the least costly is a solo 401k. It's typically one person or one person and their spouse. They own a private business and they want to contribute. What I love about 401ks, if you're a private business owner or a solo business owner, $70,000 a year, you get to write off your income. That's amazing. And being in the market when the market is up, why not? Why not? You know, make money. Same rules apply to the 401k. There are no restrictions in terms of, because it's just you or you and your spouse or loved one. So you guys can kind of work based on your household working budget, what works for you. I love solo Ks. So those are the top three. Now, one other addition to these IRAs, and I promise you, I would implore you all, jump on these IRA plannings now. I work with CPAs and they call me and they'll say, Victoria, got a client, we're at the deadline, it's April, we have to file an extension. Can you open the client up a solo K really quick? Because I'd rather them pay themselves the $70,000 before they send the IRS $100,000 check. Okay, so if you'd like more information, I implore you to call me or any financial advisor that you trust so that they can make sure you're taking advantage of every opportunity that's available to business owners as it relates to IRA plans. The money grows tax deferred. If you do a Roth IRA, which is new, came out, a Roth simple, money grows tax avoidance. So there are no tax. I think there's taxes coming out on the earnings, but going in tax deferred. So Roth is amazing. Another topic there, but with a Roth, everything's on an after-tax basis. Lastly, my sweet potato pie, my annuities. Listen, when I first started the business, people hated annuities. They had 14-year surrenders. It was like, annuities, you Google it and it'll be like a red flag. Don't do it. That's not the case anymore. Annuity owners, which are earned by insurance companies, got smart. They gave you a lot of bells and whistles. To me, annuities have now taken the place of the common day pensions. It gives me so much peace of mind trying to navigate being a mother of grown children, which for you parents out there is sometimes difficult, helping them navigate making grown people decisions. I can't just focus on my clients and their plans. I have to focus on my life and my kids and help make sure they're doing the right things along the way because they're my greatest investments. But in that, annuities give me the peace of mind as an advisor, knowing there are some level of guarantees along the way, because I can't tell you what the stock market is going to do in the next hour, let alone what it's going to look like in 20 or 30 years when you retire. But what I can tell you, if we make good short-term decisions for long-term success, we're going to be mighty all right. Okay. And I use annuities because they complement my IRAs. There's so many good ones with zero fees, 100% uncapped performance, meaning I'm going to be invested in the IR in an index like at the S&P. You're not going to charge me a fee. I'm going to get 100% of the growth. And if it should go underwater, I'm protected for the first 10, 20, or 30% of loss. It's like a no-brainer to me. But there has to be money you're willing to part ways with, because annuities, just like these other ones, have the 59 and a half age provision to pull it out. Does that mean you can't? You can always touch your money. I don't believe in ever giving up control of my money under any circumstance. I always want to be in control of resources that I've earned. However, sometimes you got to give a little to get a little. So annuities, not all created equal. There's some good, there are still some bad, but it's important to know the good, because the good is great when you find the right one. And I have clients with testimonies that will tell you, including myself, they're great. And they complement all the IRAs I have going on and my husband has going on in his world, and my friends. I have friends who just opened businesses. Shout out to my girl Tammy's Little Cafe in Conyers. Just opened a thriving business. And so when she and I are out, we practice this in our normal conversations. What should I do? What should I open up? Well, you need to capitalize on this thriving business, set up some 401ks for you and your spouse, and so forth. So that is it. And I'd like to keep the floor open for questions. I know I've given you a lot, and Chike does have some little brochures that he'd be happy to send to the board so that you can take whichever brochure on whichever IRA deemed suitable for your business. It will be a good outline to kind of navigate you in the right way. And so I also have my bio. If you want to reach me, I have all of that information for you as well. But I want to thank you all for giving me this opportunity to share some things with you. And I hope that you garnered a lot of information today. And I hope when you close your eyes and you envisioned it, I pray and I really do hope that it is manifested. And that's it.
Woo!
Really.
That's why I love you, Victoria. That's why I love you. It ain't just because your name is the same name as my mama. It's just because you're so
You didn't
amazing
tell
and
me
so
that.
awesome. You're just so awesome. Anyway, so real quick, can you just give them your contact information right now?
Yes, I can.
All right, so y'all, she about to give you her contact information. Write it down.
Okay, so we're supposed, back in the day, we didn't have all this technology. So people have my cell number. And because I consider my clients my friends, and they call me all across the board for all kinds of financial decisions. So I am, because we are on a webinar, I am going to give you my global relay number. Sadly, I really
Yes. Give it that number.
I have to check in for that. You caught me off guard, Chike. Chike,
Oh,
let's
I
get
got
some
it too.
questions. Why do you have my global relay number? It should be
I got
on
it. I'm gonna type it. I'm gonna type it in. I got it.
Okay, type it in there.
Okay.
But my
That's
email,
the
V is in Victor, my last name,
Yep.
Lowery, Lowery, at financialguide.com. I repeat, V, my first initial, last name, Lowery, at financialguide.com. And listen, let me just say this. There is no such thing as a dumb question. So do not call and say, I got a question. I know it's no, it's not. If you're going through a divorce, you have stepchildren, you can call me. No judgment.
Yep.
We're all in this together.
Yes, we are. And
Mhm.
so we had a couple questions. I answered two of them. Brother Charles asked, if you don't have anybody to leave the money to, do you still need life insurance? Honestly, I think that it's a permanent life insurance is both. You get to use it while you're alive. And if you have a charity or siblings, you could leave the life insurance money to them afterwards, right? And then we had a question on Joseph, the ABC Member of the Year, asked, can you convert any of the solo K, SEP, or simple? Can you convert them
Into a Roth, I'm assuming.
into anything?
Yes, you can. So you can convert all your IRAs into a Roth. You can also do rollovers. So for example, let's say you had a SEP, you had a business, and you no longer are a part of that business and you left and you were the employee of that business, let's say. You can convert like to like registration. So if you're leaving a SEP, you can convert it into your own SEP or an IRA. You can convert any of those qualifies into a Roth. It's called like a backdoor Roth. So you can turn a tax deferred IRA into a after-tax Roth. You just have to pay the taxes upon conversion. So yes.
Okay, awesome. And the global relay number, that's the 8853, right? Yeah. It's not the one it's not the one you text me on this morning, right?
No, it's not. It's not.
Okay, that's all I need to know. That's all I need to know. Okay.
All
right. So y'all, I'm gonna type this is Victoria's information in the chat. And then we also had a question. Oh yeah, the recordings, y'all. These are all the Atlanta Black Chamber recordings are available on our YouTube page. Please go subscribe. You're missing some stuff, y'all. All right, so we had another question. Let's see. Oh wait, somebody asked Kimberly, real quick, 2 minutes. Kimberly, you on? Kimberly. Hey, Kimberly, what you want to talk about term? What you want to say?
Oh, you put me on the spot. Let's go with it.
Listen, y'all, hold on. If you've ever been on a Tuesday Talks with our esteemed President and CEO, MC, the best dressed man in Georgia, you know you gotta be ready.
Well, yesterday was my first time, but let's go with it. So,
okay, welcome.
Yeah. With term, I've been an agent for a decade, and initially I was like, I'm anti-term, but what I realized, as you stated, it does give you a larger death benefit, but unfortunately for Black and brown people, we have more medical crises than any other group of people on this side of heaven. So I encourage people to get term for the chronic critical illness riders. So just in case your illness don't take you to the grave, you still can maintain your
Yeah.
lifestyle while you go through chemo or
Yeah.
another major issue. So not just in terms
Yeah.
of death benefit, but just knowing that
Yeah.
term will allow you, with the right companies, it will allow you
Right.
to have chronic critical illness riders to protect your family as you go through illness.
Yeah. And so that's one thing we have also at Mass Mutual. And what she's talking about is, let's say you have $500,000 of term insurance and something happens medically, you know, chronic or like you're about to, like, you know, and you need medical money. Most companies will allow you, I believe, 50 to 70% of the death benefit you can use while you're alive to pay for your medical benefits. And then whatever's left over would still go as a tax-free check to your beneficiary, y'all. And so what she's saying, that it is a living benefit, but it's not because you're living a long life. It's because you're living and you need help with medical, you have a medical issue that's a critical or chronic illness, and you need the money to pay for that, right? Janita Green. So Janita, I met Janita's brother at a resort in Orlando. And the reason I met him is because I had on a shirt from one of our money team members, right? And it had a scripture on the arm. And her brother tested me in the elevator and was like, "What does that scripture mean?" I said, "I know the scripture, brother." And then I told him I was from Atlanta. And he said, "So is my sister. She's a CPA." So, y'all, real quick, Janita, can you unmute and ask your question? Because, you know, we family. So you go ahead and unmute and ask your question.
Sure. Hey, everyone. Hey, Chike.
Hey.
Great presentation. I'm happy that I was able to make it today. The question that I asked was, can Medicaid be privy to life insurance proceeds if the recipient receives Medicaid assistance as part of elder care, you know, whether they're in a facility or at-home care?
No. So the great thing about life insurance, temporary or permanent, is that that check is going in whole to an individual. What that individual chooses to do with it is on them. That's why we say you shouldn't have kids, right, as beneficiaries, because we know you leave a 17-year-old $1 million in Atlanta, we know what's going to happen. So are you asking if it's going to affect their Medicaid once they get the benefits? Is that what you're asking?
Once they pass. I've seen language where Medicaid says that they can receive the beneficiaries or receive the recipients' life insurance proceeds or retirement monies, you know, as a part of making up for money that Medicaid provided in care.
Yeah,
You know, that sounds interesting. I actually heard something very similar, Janita. Chike, if I can, what I always recommend to my clients these days, they're changing the rules on everything. And one thing I do know, the more debt we fall into, the greater they're going to tap into our earning, our piece of the pie. So I always recommend my clients, if you know you have an ailing parent, or like Chike said, a young child, omit them from the proceeds. If you know they're closer to meeting the man upstairs than not, leave the proceeds to a trust, because inside the trust, which is a legal binding document, it will dictate and speak for you when you're no longer here to speak for yourself, and allocate those assets in a way that can't be touched by anyone other than what is in that trust. So I would recommend, for especially as business owners, each of us on this should and need to have a living will, you know, a directive, but we also need a trust. So I would, and trust is so inexpensive. And actually, I wish I had the link, Chike. There is an amazing site where you can do it online. And it's like $300.
Yeah.
You can set it up online.
Yeah. There's so many resources now. But what she's saying is true. And to that point, whoever your beneficiary is going to be on your life insurance, just make sure that they know they're the beneficiary. Make sure that they're going to be able to use those monies somehow. And even if they put it in an annuity and they just live off the earnings, right? An immediate annuity where they put the money in and they start receiving payments right away. I was watching something in Shaquille O'Neal. Y'all know Shaquille O'Neal got money. I don't know if y'all know this. Shaq is wealthy.
Yeah.
He said one of the things that changed his life was somebody telling him about annuities.
Yep.
Right. And so I love them. You know, Victoria helps my clients with them and she schooled me on them. And so, yeah, that's something to think about. Brother Joseph said, can you convert the cash value of a life insurance policy to a long-term care policy? So 2 things. You can use the cash value in your policy for whatever you want. So if you want to use the cash value from your policy and get a long-term care policy, yes. And there are riders that you can add on to your life insurance, one of them being a long-term care rider, Joseph. So you can keep your cash value, keep the death benefit, and have a long-term care insurance rider all in one policy. So you don't necessarily need to use the money to do that. You can use the money for it, or you can just put a rider, and a rider is just an additional thing. So one of the riders that I use a lot when I'm insuring young kids is a GIR, guaranteed insurability rider. What that means is I believe it's under the age of 14 or 15. If you get a child a policy under that age, what our company will allow you to do is from the ages of 27 to 43, every 3 years, your child can then, well, they're an adult now, they can add an amount of insurance to their death benefit, right? Guaranteed without any medical questions. So I think it starts at 50,000 and it goes up to 125,000 is the max. And that's every 3 years, the company would say, hey, do you want to add this insurance? And they say, no problem. Another 3 years later, they're going to say, hey, do you want to add this insurance? Yes. And what's cool about that is, you know, you get it for them as a kid, but when they grow up and they have their own responsibilities, a home, a family, kids of their own, now they have, despite whatever's going on with their health, y'all, they can have guaranteed increases in their death benefit of their policy over the years. And I think it's, what is it, 7 or 8 times they do it in those from age 27 to 43 every 3 years. I think it's like 7 or 8 times. And y'all, that is a game changer.
Yes,
it's a game changer because honestly, with the way they doing stuff with food nowadays and all that, when you get your kids permanent policies. Think about this.
Yes.
The Rockefellers do this. As soon as you're born in the Rockefeller family and you got a name and a social, the third thing you get is a whole life policy. The third thing, y'all, the third thing, name, social, whole life in a Rockefeller family. Guess what? That premium that your child is paying, if they don't add any insurance later, that premium for $1 million of insurance at the age of 2 is the same premium for their entire life, y'all. That's the gift that keeps on giving. And if you get it for them that young, it's going to be the 529. The child can then use the cash value in the policy to pay for college if that's their thing, buy their first home if they want, start or buy their first business if they want. And so with youth policies, y'all, I promise you the guaranteed insurability rider is a game changer. Can I have my kids take out their own policy on me? Can your kids take out a policy on you as long as they can pay for the policy and they have some form of income to pay for the policy? Absolutely, Renee. I hope that answers your question.
Chike,
yes,
really quick,
yeah.
I would be remiss if I didn't say this. It's just in my heart. So currently, you know, at my age, I'm dealing with elder parents, and I was just having a conversation. We need to be more mindful of, in addition to our retirement, long-term care. Someone mentioned long-term care. Great point. We need to be more accountable for how we want to live out our life if we fall into some type of immobility or sickness right? Because people are
Yep.
living longer, but they're more sickly. The average age of a nursing home used to be 70, 80. Well, now it's 60. Just let that sink in. So
Mm.
you need to have a conversation with your children, if you have any. How do you want them to take care of you? Do you want that burden, that financial burden, to fall on them? If not, and you want to be accountable to cover those situations if they come, long-term care can be purchased, as Chike said, through a rider with insurance, but also annuities have riders too.
Yep.
Can't mention any companies' names, but there is one
Yeah.
particular company that is offering like an income doubling rider if you were to ever suffer a long-term care event, which people do. I don't know about y'all, but I have plenty of people suffering from cancer now and strokes, and it's crazy.
Mhm.
And they're
Yeah.
young, and their
Yeah.
loved ones have to figure out, how do I afford $4,000 a month for respite care, nursing home care, but these annuities are ways where you can get those benefits. Your income will automatically double if you suffer a long-term care event, just automatically. So you can use that extra income to cover someone to come in your home and take care of your loved one or go to the nursing home. So
Mhm.
just keep that in
Mhm.
mind. When you're thinking about
Yeah.
retirement, think of all aspects of retirement.
Yeah. Yep.
Okay.
Yep. Yeah. And that's amazing. That's a really good point. Thank you for adding that. And Renee, I'll add to the answer of Renee. And for your kids, they shouldn't be the beneficiary. I know we said that. I don't remember, say it again. Your kids can, as long as they have income, right? Because the insurance company wants to know that they can pay for this policy for a long period of time. They should not be the beneficiary, right? If they're under the age of 18, because legally they can't sign for any documents, especially a $500,000 million check, right, from an insurance company. So just be mindful of that, Renee. Any last questions, y'all? It's 12 o'clock. Oh my gosh, where did the time go? They say time flies when you're having fun. And
That's right.
this is amazing. This is like, thank you, Dr. Deshonda, for joining us. I know you got to go. This is really vital information, y'all.
It
I'm so
is.
glad, Victoria, that you were able to be on here with us.
Anytime,
Everybody,
Chike.
yep. Victoria's information is in the chat, y'all. Okay, good, Renee. Good. And if you need to talk more about that, Renee, I'll put my information in the chat too. I'm mad I didn't do that. Let me put my and so yes, these are the conversations. Somebody put this. These are the conversations we need to be having, y'all.
Mm-hmm.
Like real talk. We not sugarcoating nothing.
Mm-mm.
This is what it is. We do this. I've been in insurance and investments for almost 2 decades, and I'm really passionate about this, y'all. This is my life. We do this in real life, y'all.
We do this.
Let me say this again. We do this in real life. We are not no social media influencers trying to sell a course. I mean, I got books, but that's not what I do this, right? I got books, but that's to help people. We do this in real life. I'm halfway to getting my chartered financial consultant designation and my certified financial planner designation because I'm serious about this, y'all. We do this in real life. So if you need help with any of this stuff that we talked about, reach out to us. Thank you for joining us. I'm going to stay on for a couple more minutes because I know I don't know. Some people might have questions later. So I'm going to stop the recording, but we're going to stay on for at least 5 more minutes. If anybody else wants to ask any questions or anything like that. Victoria, I know if you got to hop off, please. I thank you so much for your time today.
I'll stay on for a couple of minutes just in case there are more questions. But Chike, I would love to delve deeper into this long-term care only because it is prevalent. The time is now for us to help each other.
Yep. And I just want to say thank you to our president and CEO, Mr. Melvin Coleman. And if you haven't checked out the latest edition of Acknowledgement Magazine, that guy is sharp on the cover, y'all. MC to MC, the best dressed man in Georgia. Thank you, Melvin Coleman, for allowing me to do this and allowing the chamber to just grow under your watch. We appreciate you so much. Thank you for everybody that joined us today. I'm going to stop the recording, but I'm going to stay on. And the recording, stop recording.